Welcome to the futures contract. You may remember in file 1A you had a forward agreement. Essential agreement was it was customizable by the parties, but it had counterparty risk and it was also not liquid. In 1B you saw the novated version of the forward contract. It was run through a clearinghouse. It had the customization of the original contract, but it had no counterparty risk and had high liquidity. This is the futures contract. The novated forward contract was designed to imitate the futures contract. So you're going to see a lot of similarities between 1B and the futures contract. What I want you to be able to do is go back and look at 1B and look at the futures contract, and you'll be better able to see the similarities. This is very short. We don't have a long discussion because you already have a lot of information from the novated forward contract. So we're starting out with the futures contract, which looks very much like the forward. We have a buyer and a seller. In the case of Cowboy, the Cowboy is the seller. He's selling a stock through the futures contract to the buyer, Wonder Woman, who pays her money to the Cowboy. Now, futures contracts really don't trade in stocks. I just was trying to carry the parallel to 1B, but they do trade in commodities. It could be foods, it could be metals, it could be gold, silver, oil. We also have them based on indices. You could have the stock index or a oil index or some other kind of index. It's also on interest rates, and it's also on bonds. So it carries a wide variety of securities that you can trade on. And the key thing is you have some strong characteristics that are good and bad. The first is the bad. The exchange sets the terms of the contract. It says what security is going to be delivered, the quantity is going to be delivered, and what is the date it's going to be delivered. So it's not customizable at all. It's very standard. Every futures contract is identical. The market, however, sets the price. So the futures exchange says you're going to be delivering a certain kind of oil, a certain quantity of oil on a certain date, or a certain quality of soybean, certain quantity of soybean on a certain date. Those are the kinds of things. Or it could be you're trading on the S&P 500 index. It tells you the size of the contract, how much each movement in price is worth, and the date the contract expires. Very liquid, easy to buy and sell. No counterparty risk because there's collateral. We'll get to talk about that in a moment. It's called margin. Gains and losses are calculated each day. It's called marking to market. That's the same with the novated futures contract. But in a novated futures contract, money never actually passed from one party to the other. It just was set aside in an account to pay the party that's receiving money. Here, every day, money is transferred from one person's account to the other. This is called daily settlement. So futures have no counterparty risk, easy to sell, mark to market with daily settlement. And daily settlement is different for the novation. There is no daily settlement. Let's take a look at this in an example. Here we have a buyer and a seller. The right-hand side is the seller's account. He puts up initial margin of $500, means it's a deposit of $500. The buyer is on the left. He puts up $500. Let's imagine Monday, the price falls by $2. So the buyer is losing money, the seller is winning. $10 comes out of the buyer's account, so his account's down to $490, goes to the seller's account, which is $510. Tuesday it falls again, another $5 comes out of the buyer's account and goes to the seller's account. This is marking to market with daily settlement. The marketing to market is price falls by $10, price falls by $5, and now the price gains by $12. So $12 is moved from the seller's account back to the buyer's account, and so forth. It goes until the contract expires. Now, what would happen if you wanted to terminate your position? You know you could do that with the novation contract. Here it's called reversing out. Reversing out is a way of leaving your position and taking your winnings or cutting your losses. And all you have to do is enter into a reverse position, hence it's called reversing out. You're going into a reversing contract, you're getting out of the futures market. If I'm a buyer, the way I reverse out is I enter into a seller contract. If I'm a seller, I reverse out by entering into a buyer's contract. So Here we have Bob is a buyer. Let's say Mary is a seller. And they're the only parties in this picture. So when price is rising, Mary pays Bob. And when price is falling, Bob pays Mary. So let's imagine Bob decides he wants to reverse out. So Bob now becomes a seller in another contract, and the new buyer becomes the buyer of the contract, and that's Clint Eastwood down here. So now if we imagine price rises, Mary pays Bob as a buyer, but Bob has to pay Clint Eastwood as a seller. So the money is moving from Mary to Bob to Clint, another increase, Mary to Bob to Clint. If it winds up that the price goes down, it goes from Clint to Bob, and then from Bob to Mary. What's the point of having Bob in it? We could have just Mary selling to Clint Eastwood, and that would be the way it would end. So on completion, it's simply a contract between Clint and Mary. And as price goes up, Mary pays Clint. Price goes down, Clint pays Mary. This is called reversing out. And now Bob is out of the contract. So that pretty much summarizes the futures contract. Take a look at 1B, the novated forward contract, and you'll see the similarities and the differences.